Welcome everyone to the final session of the 2021 Indiana Leeds Summer Tax Workshop Series. I'm Leandra Lederman, the William W. Oliver Professor of Tax Law at Indiana University Maurer School of Law. And it's terrific to see everyone here today, and it's been terrific to have so many people with us this summer. So I'm really excited about this last talk at a special time. And with that, I will let Leopoldo go ahead and introduce our distinguished speaker.
Thank you very much, Leandra. I'm Dr. Leopoldo Parada, lecturer in tax law at the University of Leeds here in the United Kingdom. And it's also a pleasure for me to welcome you today. It is the last session of our Indiana Leeds Summer Tax Workshop Series, and I think we are all very happy to wrap up with an excellent topic and a fantastic speaker that I have the pleasure to introduce today, Professor Dr. Joachim Englisch, who is a chair for tax law and public law at Münster University. He also has been teaching in numerous international LLM programs. His main research activities are devoted to international and European tax law, covering both direct and indirect taxation. Since he held the Alfred Grosser Chair at Sciences Po Paris in 2018-19, Dr. Englisch has commented extensively on the BEPS 2.0 work of the OECD, and he has also developed own concepts, mostly in interdisciplinary research work together with economists. In general, he continuously advises the OECD and the European Commission on tax matters since more than a decade, and he has been giving expert advice, especially on the globe minimum tax to national governments, NGOs, and MPs. Today, Professor Englisch presents International Effective Minimum Taxation OECD G20 Pillar Two Globe. Fantastic topic to wrap up the series. So, Professor Englisch, Joachim, the floor now is entirely yours.
Thank you so much, Leandro, and thank you so much, Leopoldo, first for inviting me, for having me here as a guest speaker in your prestigious series, and also for, well, allowing me to speak on a topic that is somewhat dear to my heart, as I think you, Leopoldo, have already demonstrated by reading out a little bit what my activities were in this area. And so I'm very happy that I have an opportunity to now present a paper to you on international effective minimum taxation. And I also have prepared some slides, which I shall try to share now. Basically, this is a relatively short paper for a pretty big topic, as you will have noticed. Why is that so? Well, essentially, this is a paper that has been conceived as a contribution to the Hase-Kofler Handbook of International Tax Law, to be published with Oxford University Press early next year, probably, or maybe late this year. And as a handbook contribution, there was obviously a certain word count limit. And so basically what this paper provides is an overview of the main aspects of the Globe Minimum Tax Initiative, with a particular focus on tax policy aspects, including both a high-level assessment on the pros and cons regarding an international effective minimum tax, but also looking at a few select, because there was no space for more, design features that are crucial for the effectiveness and working of the minimum tax. And I should also mention that as a consequence, the paper has very little doctrinal analysis. There's a tiny little paragraph on tax treaty law, compatibility of the globe design, but very, very little. There's more on that in other papers because this handbook contribution builds on previous research, and it is also followed up by several other contributions. I will just mention them very quickly. There was a seminal article in World Tax Journal written by my colleague Johannes Becker and myself, which is sort of a relatively extensive predecessor to this shorter paper, which we will discuss today. However, that was pre-blueprint, so the main advancement that you find in this paper, which was submitted or last revised actually April this year, is that it covers the October 2020 blueprint. And then subsequently, Johannes and I have published another rather extensive paper which focuses on how this could then be implemented by the EU through harmonization, so through a directive. And we also cover, however, policy aspects in this paper. Then Tax Justice Network approached me to see whether I could have a look at how their design alternative of a meter minimum tax would comply with EU law. So that's published in TNI. And I have submitted for publication another paper which looks into how individual EU member states, which maybe do not want to wait for EU harmonization, could go ahead and do a national solo on the implementation, how that would be compatible with fundamental freedoms. So all of that is the work I more or less did, and most of it in this year, and the paper that we discussed today is sort of in between. Okay, first thing discussed in the paper, but I will keep that really short now, is how the GLOBE initiative evolved. So a little historical outline, basically, while mentioning that we had some discussion about minimum taxation already in 2013 in the EU in the context of the interest royalty directive, but it didn't really fly at that time. We had the BEPS initiative leading to, amongst other things, the establishment of the inclusive framework in 2016, which then in 2017 was tasked with looking into the challenges posed by digitalization of the economy as to international taxation. And up to that point, there was not much talk about a minimum tax. Obviously, that changed when we got the tax reform discussions in the US. First of all, that put a lot of pressure on the OECD to move more quickly because the reform discussion in 2017 indicated that the US were going to change its system of international taxation more towards taxation in the market. At the same time, we had the DSD spring up globally and the EU proposing the same thing for Europe. And especially when the US then eventually introduced the guilty minimum tax regime, Germany and France proposed the same for the international talks. And this was then eventually concluded as included as Pillar 2 in the program of work beginning of 2019. We then got, with some delay due to the coronavirus, but also due to the Trump administration, the blueprints in October 2020. And for quite some time, it looked as if that might be it, because Mnuchin was kind of blocking an agreement. That changed, of course, then with the Biden tax plan and Yellen pushing for an agreement. So we got that agreement, which is not as yet covered in the paper, because, as I said, the last revision was in April this year. Of the 132 by now, and the G20 a week later on a global effective minimum tax as a common approach. And the question that now arises, amongst other things, is, well, first of all, how will this proceed technically until October or November? And how is the EU to act upon that, which is, of course, a little bit a European perspective. So that's the evolution, basically. You find that in the paper. How does GLOBE work? And I'm going to go through that pretty quickly as well, because I think most of you will be aware. And anyways, I don't have so much time. So just very basic workings of GLOBE. First, you need to check whether a particular M&E is in scope, so above the threshold, and fulfilling the definition of an M&E as based on IFRS standard number 10. Then you need to calculate for each constituent entity of the M&E the profits that are attributable to that constituent entity. And as we'll see later, that will be done based on IFRS financial accounts. Then you need to identify the covered taxes to be attributed to those profits. So profits are attributed per jurisdiction to a particular entity resident there, or in case of a PE established there, covered taxes are attributed to profits. Then you do the jurisdictional blending and calculate the ETR, the effective tax rate. Then there's some adjustments for intertemporary volatility. So there's certain tax carry forwards and loss carry forwards. Finally, there is carve-outs possibly for so-called substance-based or substantive activities, and we'll have a bit closer look at that soon enough. And then finally, if after these adjustments and carve-outs, there's still an ETR below the minimum tax, you calculate the difference as a top-up tax. which is then collected primarily in a parent jurisdiction under the top-down approach, normally the ultimate parent jurisdiction, by way of an income inclusion rule, sort of an extended CFC regime. And otherwise, if no IRR applies, you would collect the top-up tax in source countries through the undertax payment rule, design of which is still to be specified. And that leaves you with this picture here. So you have primarily the income inclusion rule in the ultimate parent jurisdiction or another parent jurisdiction. If we're talking about foreign PE profits to which, based on a treaty, a tax treaty, the exemption method should apply, this might be complemented by a switch over rule to be introduced into the tax treaties. And as I said, as a backstop subsidiary means of collecting the top-up tax, we have the UTPR in the source jurisdiction, and also as a compensation for developing countries, because as we shall see, obviously the revenues go more to developed countries where parent entities are located. You get with first priority a simplified minimum tax in the form of withholding tax, which is to be authorized in tax treaties by way of a subject to tax rule. And basically this STTR is based on nominal rather than effective rates, and is also lower the rate envisaged now than the regular minimum rate. But this is not really covered in the paper, and so I will not cover it any further in my presentation either. So let's then have a look at the policy rationale, and that's, I think, where it starts getting a bit more interesting. Now that we saw the basic workings. What can you say in favor of the GloBE minimum tax? What's the idea behind it? What are the arguments that can be brought forward in its defense? And as you will probably know, at least if you read the paper, I am sort of in favor of this initiative. So here you find the arguments. First of all, it's intended to curb remaining BEPS opportunities by reducing the incentives for BEPS. So it's not a targeted approach. It's an approach that seeks to reduce the attractiveness of profit shifting base erosion because you gain less of it. So by lifting the minimum or the effective tax rate to 15%, you can't gain so much anymore from shifting profits. You will gain less, and that makes profit shifting relatively less attractive. So at the margin, you will invest less in profit shifting because you gain less from it. It will not eliminate BEPS, but it should curb it. And there is then some who say, well, BEPS has been dealt with 2015, but there's ample evidence that basically due to the inner workings of the arm's length principle, there's still a lot of BEPS opportunities around. BEPS has become a bit more costly for businesses, but it's still around. So this is intended to curb BEPS. It's also intended, that's the second big point, also mentioned in the July statement of the 130 at the time, intended to provide a floor for international tax competition. So that basically it should not be attractive anymore for jurisdictions to offer a rate, effective rate below 15%, because that would then be compensated elsewhere by levying top-up tax. And thereby international tax competition should have a floor in that basically no country is confronted with a game where the tax rate goes below that level, and so it feels pressure to also reduce its tax burden, as we have seen over the past 20-30 years empirically proven. So to have a floor for that, not to eliminate it, but to limit it. And that is, of course, a paradigm shift. If you think back to the 2015 BEPS report, still, it was only harmful tax competition that was considered problematic, not tax competition in itself. That has now changed with the minimum tax agreement. Of course, what we could get is increased headquarter location competition. So this kind of competition might actually increase because MNEs might try to escape the application of the IIR by moving their parents, so their headquarters, to a jurisdiction that does not implement the GloBE. So that's something that needs to be addressed, and we'll talk about that a bit later and maybe discuss this. By reducing tax competition, we should get a more efficient capital allocation. The less taxes distort discrete investment decisions, the more actual economic circumstances matter for where. So basically workforce training, resources, natural resources, etc. matter for where investments are located. So we should have efficiency gains here on a global scale. At the same time, it reduces distortions of competition. As we, I think, all know, the fact that foreign subsidiaries can escape taxation can be used by countries as strategic trade policy. That's what the US has done for a long time by having an inefficient CFC regime. And so that leads to MNEs having advantages by being able to exploit low tax regimes through transfer pricing, through IP location, etc., over the local competitors. There's local SMEs which cannot avail themselves, or not to the same extent, of those tax planning schemes. And by having a minimum tax, you reduce those kind of distortions of competition. You thereby also enhance tax fairness, at least if you believe that the corporate income tax is there for a reason, as a prepayment basically for the personal income tax. And if you don't believe that, you might say a little bit more cynically, maybe at least public perception of tax fairness is enhanced, and that is something important, at least politically anyways. And it is to a certain extent, of course, a revenue raiser. So according to the estimates of the OECD, with a 15% rate, as it is now agreed as the minimum rate, you'd have between 50 to 100 billion revenues annually, basically being levied from large multinationals. So what are the counter arguments? Well, I think most of them are well known to this audience. I suppose I'll go through them quickly. I will not comment for lack of time. We have to discuss it after my presentation, I guess. First, it infringes the sovereignty of low tax jurisdictions who want to use tax expenditure, tax incentives, or a generally low effective rate of taxation to attract investment. Because it kind of partially renders that strategy ineffective. By increasing the cost of capital, at least when GloBE were comprehensively, or rather comprehensively implemented, you might reduce investment, at least if you don't believe in a global savings plot, which would then basically lead you to the conclusion, probably not. But if you don't believe in that, raising cost of capital would mean reduced investment or dampening investment to some degree. Some would tell you tax competition always enhances welfare, even if it's to the very bottom. And so if you curb that, you reduce welfare. Basically, that's the public choice attitude towards government, the Leviathan attitude towards government. So if that is your way, you view government basically as a wasteful institution, you will not like GloBE. Then especially developing countries have said, well, basically the revenues go to the ultimate parent countries. That's usually large capital exporting countries, so industrialized countries. We don't get so much. The STTR will not fully compensate us for this, so that's unfair. And in a way, that's true, but that was done for reasons of administrative efficiency, and probably developing countries should look for other ways in increasing their tax revenues. But again, up for discussion. It violates capital import neutrality to the extent that the local rate is below 15%. Yeah, that might not be such a grave concern for reasons we might also wish to discuss later. It's not aligned with the value creation principle, because taxation will not occur necessarily, at least where value was originally created. Well, that's mostly true, but then again, it's about subsidiary taxation, not about primary taxing rights, so maybe not the strongest argument. It will certainly increase compliance enforcement costs of the affected multinationals. And then especially my esteemed Oxford colleagues always point out that you need a critical mass of willing countries to make this really effective, which is true. And they think a bit different from me. This is unlikely to happen. Okay. A few words on critical design elements. And again, you could say so much more on this. I mean, the blueprint is 200 pages full of sort of critical elements, but I just picked the most important ones, or some of the most important ones from my view. And they're treated with rather superficially, of course, in the paper, because there was just no room to go in depth. But I think some major issues, nevertheless, should become clear from the paper. First, there was always, for 1.5 years, it was discussed, should we have global blending, such as it is currently still the case under the US GILTI rules, or should we have jurisdictional blending or even no blending? And a choice was made to have jurisdictional blending. That was really a trade-off where the countries basically decided we want to have a more effective instrument here. We pay the price of having a higher compliance cost, so somewhat reduced efficiency of the entire thing. Basically, it's much more effective if you have jurisdictional blending, because if you were to maintain global blending as under, the GILTI, that means there's still a huge incentive for smaller economies to offer very low rates, which could then be offset by higher taxation elsewhere, which you can't escape for some reason or another. So the business model of those countries would basically continue. Tax competition would continue to a great degree. And therefore, basically, a decision was made to have jurisdictional blending, which I fully endorse. Rather revolutionary is to calculate the base for the purposes of the ETR calculation, so the denominator of the fraction that you need to calculate the ETR, not based on local tax accounting, as is standard on the CFC rules, but rather by using consolidated financial accounts that are either IFRS or IFRS equivalent. Basically to allow for international coordination of the GLOBI and to reduce compliance costs, because this is information that is usually already available in an M&E. There's relatively few adjustments currently in the GLOBI blueprint regarding book to tax. And my prediction is that we might, in the end, see some more than in the blueprint. For one reason, it might be necessary to have a bit more flexibility with respect to national tax accounting rules, where differences from IFRS are not really relevant under BEPS aspects or with respect to tax competition for IP. So we should accept them. Another thing is we could also see more mandatory adjustments to reduce tax planning opportunities that might arise from discretion on the financial accounting standards. So basically, M&Es trying to reduce the base, so reduce the financial account profits, and thereby increase the effective tax rate with a given tax, covered tax. And so to avoid that kind of planning over time, I think we will see more adjustments. Let's leave the tax credits aside for reasons of time. The third point is a big contentious aspect that is still not yet fully resolved is the carve-outs for routine returns on substantive activities. The statement of July this year, which of course is not as yet dealt with in the paper, tells us that now it's going to be 5% on the aggregate of payroll and no longer depreciation, but actually carryover values, so a bit broader base for this carve-out, and therefore, on the other hand, a lower rate, 5%, or in a transition period, 7.5%, rather than the 10% originally envisaged. Basically, that's a political compromise to be accepted, even though it undermines to a certain extent the effectiveness of GLOBI when it comes, especially, of course, to providing a floor to international tax competition. Basically, this means, and most or many countries wanted it this way, that for real investment, we will continue to have a certain degree of tax competition. The question is from the business perspective, should that maybe be optional? First of all, because it creates additional compliance costs. You might wish to avoid that if you feel it won't help you so much to have this carve-out. Carve-out might even be disadvantageous because it means that maybe higher tax substantive activities can no longer be offset against maybe lower taxation in an IP box. So maybe an M&E doesn't really want that. And so in my view, it should be optional. You can raise the question, maybe up for discussion later. Well, if we have a carve-out for substantive activities, how is the globe then still different from an expanded modified CFC? So why should we have this rather than just modify our CFC legislation? Maybe we can discuss this later. And of course, with respect to the collection mechanisms, we have the particular problem in the EU that if we were to implement them without any modification, they would be discriminatory under the understanding of discrimination in the court's case law. So we need to find a solution for this, and it's already being discussed, but not in my paper. Okay. As I'm sure you are aware, Oglobi is a common approach. It's not a minimum standard. So countries can decide whether they want to implement that. Only if they want to, they should or must follow on the model that is provided by the OECD. So as Pascal Saint-Amand has quite pointedly formulated it, Oglobi is about the international coordination of what is in essence unilateral measures. And that raises a few questions. Should we have a multilateral convention to streamline implementation? I mean, we need one, and that is very briefly touched upon in the paper, to amend tax treaties, at least when it comes to the STTR, to the switchover rule, and probably, at least for clarification reasons, also when it comes to the UTPR. But I don't think we need one in addition for the design of the actual legislation or national legislation. There should be more flexibility. This may raise additional issues. You know, you have particular problems when it comes to treaties in the US Senate. So maybe better to have just model rules and a peer review. I think that's more effective. And finally, final word here, simplification mechanisms. That is going to be crucial to keep compliance costs low, to increase efficiency of the entire thing. And the most promising avenue here is country-specific guidance. So basically telling MNEs, look, in a particular jurisdiction, you don't need to do an ETR calculation, or you only have to do it if you benefit from certain particular regimes in that country that are potentially going to push your ETR below 15% or whatever it's going to be in the end. And this is something actually that a colleague and I were mandated to develop and vet. And we did that, and we will probably find that then in the November compromise on technical details of the entire thing. Okay, that was it. I think I stayed within the 25 minutes allotted to me, and I'm going to stop the screen sharing. Thanks a lot for listening, and I'm very much looking forward to the discussion now.